Billionaires' warning of the economy, financial markets, and commodities. So to kick off this video, I just want to share that I did this recent video called Own Gold, Silver or Cash, and in it we discussed, well, what should you own right now? Gold, silver or cash? And based on the markets, based on where interest rates are going, bond yields, all of that, and the debt bubble, where should someone be invested? Now, personally, I have all three and other positions as well. I still got a couple of investment properties, although I have sold the majority of them in 2021, and you'll hear more about that shortly. I own a lot of the physical gold and silver. I own a lot of gold and silver miners and explorers. And in fact, I actually want to buy some more, but I'm not. I'm holding off. Why? Because I'm building up a cash position. Because I'm seeing where I believe interest rates are going and what's going to happen to asset prices. And yes, in terms of CPI, my purchasing power, my cash is losing purchasing power. But I think it's going to gain purchasing power against these assets when I think we're going to see significant falls. And what I will do personally, and look, I've trimmed some profits. I've taken some profits off the table, and I've shared that with you guys before. But I will use a portion of my cash holdings to also buy put options on individual stocks and bear call spreads and short this market on the way down. I haven't pulled the trigger on any of that yet, but I'll do that. But the majority of my cash will be sitting there waiting to pick up beaten down undervalued stocks, which are already, in my view, undervalued as it is. So if you haven't watched this one, I'll put a link in the description below. Now, I also talked about, in this video, 1970 stagflation returns, and you're going to hear from Billionaire Paul Tudor Jones, who also talks up the similarities of the 1970 stagflation. In particular, he mentions the 1973-74 recession, where asset prices crashed 50% in nominal terms, while CPI remained elevated at 12.5%. And I have talked about this on this channel for quite some time now, that I can see that type of scenario happening again. Not playing out perfectly, not doing exactly what happened there, but quite similarly. And then I did this video, Don't Fight the Fed, and Jim Bianco really argues why inflation is now a political issue. And it is. It is a number one political issue. It is a number one social issue, not just in the US, in Australia, and really around the world now. And, you know, as former New York Fed trader Joseph Wang says, if you try to fight the Fed, you're going to lose. You're going to lose badly.
One divergent comment. I was at dinner last night with the head of a really big conglomerate in the States, and they're an energy. They're known as an energy company, but they have just a multitude of investments. And he made two really important points. One was they're not investing in energy because the ESG concerns are so great that it just makes them want to stay away from that space. And they can't get credit because banks don't want to fund that because of ESG concerns. So I thought that was very telling. It makes me a lot more constructive on oil and commodities than I was before I heard that. And he also mentioned, because they have some businesses in Russia, that the lagged impacts of inflation are just now really starting to manifest themselves. So much of what we saw at year end with rising wages, supply chain issues, they're actually just now starting to push through and will continue to push through over the course of the next couple of months. So if you look at the history of inflation, there's a hysteresis effect where there's a big lagged effect of it. So I think we're not going to see, clearly inflation's not accelerating, it's decelerating. But I think it's going to be much harder to tame than we think, and it's going to take much longer, and it's going to be much more challenging for financial markets as a result. And if we stop short, like we did in the mid-70s, remember, we had an inflation bulge in 70, another one that looks just like now at the end of 73, beginning of 74. The Fed hiked enough to put us into recession late 74, right. And then they stopped, and then we got that massive inflation bulge in the latter half of the decade. And again, you're going to have to really watch what central banks do here. How serious are they about truly killing inflation?
And Yellen sees solid growth, possible soft landing for US economy. And in March, Janet Yellen said her base case for the US economy was a soft landing. Today, she called such an outcome possible. And Jesse Felder is sharing Bridgewater's update with Ray Dalio. You all know Ray Dalio. And he shares a quote from this update. Central bankers are forced to choose between tightening at the cost of an economic downturn or allowing higher inflation. Odds favour moving too slowly and not enough, which would make inflation more entrenched and require more aggressive action later. And coming in from the Financial Times, the world's largest shipping group issues warning over stagflation and Chinese factory closures and the risks that builds up in the global economy. And from Zero Hedge, US services surveys scream stagflation as orders slow and prices surge at record pace. And DHL sees inflation accelerate in the future. Fuel price inflation passed on through usual well-established mechanisms. Additional measures, mainly through yield management, implemented to address broader inflation acceleration. That's from DHL. And in the Eurozone, inflation, or CPI, has moved up to 7.5%, its highest level ever. At the same time, the ECB is still holding interest rates at negative levels with no plans to normalise. This is perhaps the greatest disconnect between monetary policy and rising prices that the world has ever seen. And Lynn Alden says that it's actually the biggest disconnect since the 1940s. So really, none of us alive has ever seen anything like this. And now we've got the EU proposing a ban on Russian oil. And in fact, I've just heard that they're enforcing insurance companies not to insure Russian shipping, no matter where it goes. So, if Russia ships oil to China or to some other friendly country, then there's no insurance coming their way. Although I'm sure they'll find it somewhere. But what does this do? This takes more oil out of the market, increases prices, and as I've shown in charts before with CPI and oil, there is a wonderful correlation there. And if CPI remains elevated, what are central banks going to do? What's going to happen to bond yields? And Tavi shares this chart of oil. He says, oops, oil looks to be breaking out from a bullish pennant. Now, what Europe's doing regarding sanctions and whatnot, and forcing insurance companies not to insure shipping from a particular country. I've got to watch what I say now. Gee whiz. It's amazing. Anyway, they're shooting themselves in the foot. And with the whole ESG movement and what, happening in the US with no investment, and, you hear from Paul Tudor Jones, who spoke to a big energy company who's no longer investing in energy because of ESG. We are seeing a lack of investment, and banks don't want to lend to this sector and other mining sectors because of ESG. And so we're going to find ourselves in a supply-demand shortfall, in a very uncomfortable position. We're going to see much, much higher energy prices and commodity prices in the months and years ahead, in my opinion. And it's going to be very volatile. And, well, you guys know what that means for CPI with higher oil prices. And Italy's Prime Minister tells European Parliament there is a strong risk that rising food prices due to the Ukrainian crisis and reduced availability of fertilizers will lead to food crisis. Well, we've been talking about that for a while on this channel, haven't we? And European PPI just hit an all-time high at 36.8% year on year. It's the 8th consecutive all-time high. Previous print was 31.5%. The Eurozone have got huge problems, and a lot of it is their own doing, shooting themselves in the foot one way or another. And as Professor Richard Werner likes to say with Princes of the Yen, that was a purposeful policy to create a bubble and then to burst it to get economic, political and social change. One has to wonder, is Europe doing the same thing? And from the real bond king, Jeff Gundlach, value has double bottomed against just like the NASDAQ versus the S&P, and it's moving higher. So value is the way to go. In our current environment, the tailwind is for value outperforming growth. Now, I know you guys already knew that. You guys are pretty financially savvy. You guys have seen what's happened in the stock market in the first quarter. You've seen what's happened with growth versus value. And Tavi shares this cup and handle chart. And he says if you didn't buy silver after one of the most short-term oversold levels in history, you'll probably never buy something deeply undervalued in your lifetime.
You don't want to own bonds and you don't want to own stocks. What do you want to own? You want to own you want to own oil? Is this a commodities play for you? What's the...
You put me in a tough spot because I don't want to be the purveyor of gloom. And if we look at the 70s, there was virtually nothing that you could own that had a positive return. Gold did a round tripper, commodities did a round tripper, stocks pretty much went nowhere, bonds had negative returns over that period. So I think we're in one of those very difficult periods where simply capital preservation is, I think, the most important thing that we can strive for. I don't know if it's going to be one of those periods where you're actually trying to make money, because again, just look where we are right now. We've got negative 5% long real rates. That's unprecedented. We've only seen that 2 or 3 times in history. One was at the end of World War II, then twice in the 70s. One was in 74 and one was in 78. You just, again, I keep coming back to the 70s because it's the only other comparable period that we're in right now. It was a really, really challenging time for virtually anything. It was a fantastic time for macro, for my business. You had roller coaster rides all the time where you pretty much ended up back in the same spot quite often. So if there was a strategy that I would want to employ right now, if someone put a gun to my head, I'd say simple trend following strategies. They're not too popular today. They haven't worked really that well for the past decade. They didn't work when central banks were at zero rates. They'll probably do really well, I think, in the next 5 or 10 years, because we're probably going to be in one of these stop-start patterns with central banks. Remember, they've got Scylla and Charybdis, these clashing things. Inflation on the one hand, slowing growth on the other, and they're going to be clashing all the time. So I think we had 4 different Fed chairs during the 70s because no one could get it right between growth and inflation, and they tried everything, right? That's when we tried wage and price controls, which didn't work. We tried that for a period of time, and then finally you had to bring in the closer, Paul Volcker, to just absolutely crush the economy in the middle of another inflationary binge in 79. And I don't know if we'll get to that point, but I think there's huge volatility.
And Kenneth Rogoff says that the China supply recession is going to feed inflation. Rogoff again says that risk of US, EU and China recessions have risen palpably. And Rogoff once again says that Fed will have to raise rates to 4 to 5% to curb inflation. Wow. So that is the debate. Where do interest rates go? We've got central banks all around the world now raising rates. And the question is, how high do they go? And at what levels do they start breaking things? What levels do asset prices start breaking? And then do central banks stop? Do central banks pivot? Or do central banks continue right through that breakage and risk credit markets seizing up? So not just asset prices falling, but actual credit markets seizing up. So I think there's a lot of volatility to come.
You look at that, Paul, and say to yourself that a recession is coming. Do you say everything's on sale, I got to buy things? Do you say that I got to short this market? I mean, I know you say you don't have a strident view, but you must be telling your traders
clearly
to do
you don't want
something.
to own bonds and stocks. You start with that. It's going to be a very, very negative situation for either one of those asset classes, right? You can't think of a worse macro environment than where we are right now for financial assets. And again, one of the reasons, I think maybe the biggest differentiator between now and those other periods over the past 40 years is look at the level of overvaluation that we were both in rates as well as stocks. So that's one reason why even with this tightening in financial conditions, the Fed still probably has to raise rates to get inflation under control. Heck, we had CPI greater than 8%. Maybe it comes down to 4% this year. Maybe it comes down to 3% if they stay the course and stay tight in 2023. If you've got inflation greater than 3% on average, your purchasing power declines, cuts in half in 13 years. It's why I wish we could go back to those halcyon days of sub 2% inflation when you didn't have to worry about the value of your money. You didn't have to worry about what you were doing with regard to pay raises, and you didn't have to worry about a whole pricing and a variety of things that all of a sudden become that much more important in trying to, again, just have a normal business that you have to think about when inflation's 3% and higher, and you don't have to think about when inflation's 2% and under. I think the biggest lesson that we've all learned, certainly central banks have learned with the experimentation they did in 2019, 2020 with average inflation targeting, is that be careful what you ask for. Sub 2% inflation is a much better problem to have than inflation above 2%. It's very difficult to calibrate once it escapes like it has now. That's right. The scary part for Jay Powell is the genie's out of the bottle. And we've seen in history when the genie's gotten out of the bottle, it's really, really hard to put it back in there. So, no, I wouldn't want to be in his seat right now.
And another one from Jesse Felder, also from the Financial Times. Guggenheim's Scott Minard. I have to throw in the towel. The long bull market run in bonds has come to an end. Once again, I think we know that. I've been talking on this channel that I think bonds are the most disgusting asset class to own right now. Not financial advice, but for me, I ain't going anywhere near those things. I haven't gone anywhere near them, and I'm glad that I didn't. Which also means if the bull market, the 40-year bull market in bonds is over, then everything that is taught in finance over the last 40 years, everything that we, the 60-40 portfolios, housing only goes up, all these things, the rules have changed. We have been in a 40-year bond bull market. But if that's changed, then we need to look at what happened in the last bond bear market and what asset classes did well there. We can't look at the last 40 years and think that that's going to repeat. And that's where I think a lot of people are going to make big mistakes with their portfolios. And Jesse Felder again sharing a Financial Times article about distressed debt levels doubling in the US corporate bond market. He says the value, and he's quoting here, the value of junk bonds trading for 70 cents on the dollar or less considered a sign of distress, and a warning that a company may struggle to repay debts has climbed from 27 billion from about 14 billion at the end of 2021. At the end of 2021, it's increased that much. And when you consider the number of zombie firms, even at the start of the hiking cycle, the share of US zombie companies was 3 times higher than during the GFC. And we're only just starting to normalize rates. So if you're working for a zombie company, you may want to look at your employment situation, find another job, because your company may not be existing in the near future. And another one from Jesse Felder with his Felder report, leverage speculation in equity. So we've got the S&P 500 index and a 12-month change in margin debt. We'll have a look at a chart shortly about margin debt. And he says markets are at risk of another deleveraging event based on the 12-month change in margin debt. Now, you guys know on this channel that I talk a lot about the 1973-74 crash, where CPI was at 12.5% and markets crashed at 50% in nominal terms. And I think something similar could play out where CPI remains elevated, and yet we have a significant fall in nominal terms in asset prices due to central banks raising. And by the way, back then in 1973, I think it was, the Fed started raising rates then. Now, a lot of people ask me, Steve, why'd you sell the majority of your investment properties in 2021? And I say to them, well, my understanding of Austrian economics, the business cycle, the crack-up boom, I look at this, and this is new loan commitments, total housing values in Australia, and you can see that you have a trend line, and then have a look at what happened in 2020 and 2021. That's not normal, and it's not sustainable. That is a crack-up boom. And we know, based on Murray Rothbard's work of the 1929 crash and the Great Depression, the causes of that, and it was this. And so it's my understanding of Austrian economics, knowing what's coming. If Austrian economics is right, knowing what's coming due to this, that's why I sold. So sell in the boom. Sell, when people are greedy. Buy when people are fearful. And check out this chart of Australian retail sales. You can see the pre-pandemic trend and then since then. And if you don't think this is due to the inflation that's being created, as well as the supply destruction, we're going to see what happens between the mix of prices and volumes next week. So we'll get the prices and volumes next week. So let's see what that. I see more price increases in the retail sales market. We heard that prices were being passed on from some big retailers who warned us several months ago that they were receiving input costs rising and that they would simply pass it on. And the demand in retail has gone up amongst every other thing. So we've got an inflation problem. However, the problem is we're now entering stagflation. And stagflation is the best time for gold and silver to do well. So my prediction for year end was that the RBA cash rate, overnight cash rate, would be 2% by the end of this year. However, Goldman Sachs has come out and eclipsed that by saying that the RBA rate will be 2.6% by the end of this year. And futures markets have got the cash rate being 3.5% by August next year and 3.65% by the end of next year. And so, if the markets are right and we see, 2 to 2.6% cash rate by the end of this year and 3.65% by the end of next year, we're looking at mortgage rates of 5.65 to 6.65%. Now, based on the debt numbers that we've got, that is quite incredible. And we only need marginal mortgage holders to struggle to create big problems in the housing market. And I sent a letter out to our clients 7 months ago warning that the bond markets were telling us that interest rates were going to be rising. And all of our clients ignored that letter. Every single one of them. We got just under 10,000 clients. Every single one of them ignored that letter. Well, yesterday, after the RBA raised rates by 0.25% to a 0.35 rate, our phones and emails just went off the hook from clients out of the blue. We never sent anything out to them. We didn't do anything, simply because of the RBA finally raising and the media talking about rising rates. Our phones and emails were just going crazy yesterday from clients asking about fixed rates. Should we fix? Blah, blah, blah. I said to them, when I sent that letter out to you 7 months ago, did you get it? They said, yeah, we got it, but we didn't believe you. I said, well, fixed rates back then were 1.99. Those same fixed rates, 5-year fixed rates, are now around 5%. And the clients almost wanted to cry when they heard that. Now, a lot of them are fearful because they have increased their borrowings over the last couple of years to do renovations, to buy some investment properties, to do this, to do that, put the pool in, all this sort of stuff. So their mortgages are much, much higher, and their lifestyles have increased as well. Their consumer lifestyle has increased, and they're concerned now about rising interest rates and whether they can afford, one, the inflation, the cost of living that has gone up, their mortgage repayments going up, and maintaining their lifestyle. And something's going to give. All right, so here's that chart I said I'd share, margin debt in billions. And, well, you can see that margin debt has doubled since the March 2020 crash. Margin debt in terms of dollar value numbers has doubled. However, that's now rolled off. And with that roll-off, we've seen one of the worst starts ever for stocks in the first quarter. The year-to-date, end of April, you can see it's one of the worst performing. And that's because of the margin debt that's rolled off. And so how far or how much further can that margin debt roll off? And what will that mean for stocks? And I keep talking about this 1973-74 style recession where asset prices fall 50% in nominal terms while CPI remains elevated 12.5%. And I've shared this chart many, many times before. And with this chart, once again, what Europe are doing, we're sanctioning Russian oil and now forcing insurance companies not to insure Russian ships no matter where they send that oil. We're going to see less oil with the whole ESG thing, the whole capital investment, banks not lending into this sector. As I said, we're going to have a supply-demand issue, which means less oil, higher oil prices. And what does oil prices have a correlation with? CPI. And if you want to look at a chart going back even further, you can see the correlation between oil and CPI. And that's because oil is, or energy is, the bedrock of an economy. Its input cost goes into everything in the economy, everything that we do. It is such an important part of the economy. And here in Australia, the Australia 3-year note is now over 3%, 3.16%. And remember, it wasn't too long ago, middle of 2021, the RBA, the Reserve Bank of Australia, were buying the 3-year. They were doing yield curve control to keep the rate at 0.1%. So it's gone from 0.1% less than a year to 3.16%. The bond market is talking. We must listen. And I'm not sure if I've shared this chart with you before, though. So this has come out from Roy Morgan and ANZ. Consumer confidence has decreased by 6%. And this is a worry. This is looking at a potential recession. While we've got high CPI, what does that mean? That's stagflation. So yet I showed you a chart showing that retail sales are through the roof. Yet consumer confidence is falling through the floor. It's heading down towards March 2020. And why? Why are people not confident? Inflation. Living costs are now starting to bite. It is starting to bite. As I said, we had clients ringing and emailing us the other day just off the charts based on one cash rate rise. And I'll finish up this video with this chart. So this actually came from Mr. Dollar Milkshake Man himself, Brent Johnson. And it's business versus household debt as a percentage of GDP. And I think this is an awesome chart. And you can see Australia's household debt to GDP. And it is at nosebleed levels. And you know what else is concerning? And I'll let you guys look at this, and you can look at all the different time frames going back from the 1850s gold rush, the 1880s boom, the 1890s depression. I've talked about the 1890s depression with the Australian housing crash that we had back then. Anyway, I'm not going to go into that right now. But the other nosebleed level is household debt to income, or income to household debt. And that's at 200%. That's pushing 200%. Once again, Australia takes the gold medal there. And, you know, Australians just think that interest rates can't rise, or the government will save us, or the RBA will only raise rates a tiny little bit because we can't afford it. And property only ever goes up. And FOMO, just get in, just buy, or you'll always miss out. Well, I think based on my understanding of Austrian economics and the business cycle, the Austrian business cycle theory, and the crack-up boom, I think Australians are going to learn a very hard economic lesson really, really soon. So, as I shared at the beginning of this video, how I'm positioned, yes, I'm building up more of a cash position. I'll use some of that cash to short the market, as I said, using both put options and bear call spreads. But predominantly, I'll be using that cash to buy assets that have been smashed down, undervalued assets that have been smashed down in what I believe is coming. Hey, I could be wrong. I'm not right about everything, but I feel very confident about this, and I'm putting my capital where my mouth is. So, but you've got Billionaire Paul Tudor Jones that's issuing similar warnings to 1973, 74 with that crash, and then he talks about what happens after that. And, well, we know what happens with gold and silver. And so, I'm actually going to share next week a video. One of my favorite investors, billionaire Eric Sprott, and his secrets, I guess, in how he has created wealth in the gold mining industry, and his current holdings. So what he's currently holding in investments right now. And so I think you guys will enjoy that video. It'll be quite interesting. I'm putting it together at the moment. So, and I've got a silver super cycle video coming out as well. That should come out tomorrow. So you guys should enjoy that as well. Anyway, if you like this video, guys, please hit that like button. Give us that thumbs up. We really do appreciate it. Love to see your thoughts and opinions in the comments below. Tell us how you're investing, how you're allocating your capital. You're buying gold, silver, cash, buying tech stocks, value stocks. Love to see your thoughts and opinions in the comments below. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.